This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We now look in more detail at the personal allowance. We know already that the personal allowance is a level of tax-free income that taxpayers are permitted for each tax year. What we've also made mention of is that it's not absolutely every taxpayer who will benefit from that personal allowance. Because if a taxpayer's, we'll define this term in a moment, adjusted net income exceeds £100,000, as we mentioned before, then we start to reduce the personal allowance. If we get to an adjusted net income figure of £125,000 or more, at £125,000, at that point, the personal allowance will have been reduced to zero. The logic of the numbers we'll explain again in a moment's time. And it is an often tested area, because again, it demands a few more, should we call them, interesting calculations. It will also bring into play something that we've not looked at as yet at this particular point in time, but we'll deal in just a little while in a later section of this same chapter. All it will be is a term for you to be aware of at this point, but the usage of it we will see later when dealing with that particular issue. I'll reference that as we go through. So let's look at what we've got here in the notes. Again, we know what the personal allowance is, this level of tax-free income, currently £12,500. Available to UK taxpayers, what do we do with it? We deduct it from net income to derive the taxable income on the income tax computation, as we've seen on the pro forma on page 5 of your notes. It is, of course, there, deducted, as well as being just from total income, is deducted from the analysis columns in that order. Firstly, non-savings, savings, and finally, if relevant, dividend income. As we just said, our normal personal allowance for the current tax year 1920 is £12,500. But if, as we've said, the individual's adjusted net income, to be defined in a moment, exceeds £100,000, then the personal allowance is reduced by. Right, we take the figure of adjusted net income minus 100,000. So we're looking at the excess of the taxpayer's adjusted net income for the tax year over the adjusted net income limit of £100,000, that income limit of £100,000. And we take half of that excess as a reduction. So the normal first allowance is 12,000. However, if an individual succeeds, the personal allowance is reduced by. That is the reduction in your normal basic personal allowance. It is not the calculation of the personal allowance. It's the reduction. That half there, or if you like percentages, 50%. What that means, and sometimes the way that it is explained, is that once you go above £100,000 of adjusted net income, for every £2 of additional income, you lose £1 of your personal allowance. As £2 of income comes in, £1 personal allowance goes down. Now, if in this calculation you were to say have an adjusted net income of £125,000, 125 minus 100 would be 25,000 times a half, or 50% if you prefer. Well, there you go. There's your 12,500, the figure of personal allowance. Hence the point. Once adjusted net income is therefore at least 125, the personal allowance will be reduced to nil. So if you are dealing with a question where this calculation is required, and you can see that the adjusted net income is in excess of 125,000, there's no need to be doing this calculation. You know that the level of personal allowance is zero. And if it's a section C question, you can make that point in a note. You can say, as adjusted net income exceeds £125,000, the personal allowance is reduced to zero. You don't have to show the calculation. Obviously, on an objective testing question, you don't show any calculations anyway. So essentially, you still don't have to. If you want to do it, absolutely fine, doesn't matter, but you don't need to do that. you can just make the statement, again, as a note to the personal allowance on your computation, personal allowance nil, see note 1 or note 27 as it might be by now, and that note would say that, as we've just said, as adjusted net income exceeds £125,000, the personal allowance is reduced to 0. That is fine. You're telling the examiner, I know that point. As we know, no marks for notes or coming second in terms of an OT question. You either get it right or you don't with the calculations. So make sure, of course, that after this we practice those calculations. So we've referred to the term adjusted net income. Now we know what net income is. At least I hope you remember what net income is. Net income, of course, is the total income less, as they are called, qualifying interest payments. We are yet to see what they are. And trading loss reliefs that we've only briefly mentioned. We will, of course, deal with that again in the future. Chapter 7, I think, for that. And that, of course, is on your pro forma page 5. And adjusted net income, so now the adjusted bit here, is the net income, as we have, let's try to cross it out, but let's underline it, is net income less the gross amount of any personal pension contributions and also less any gross gift aid payments. Now, that is in section 5 that will be coming up after we've dealt with the personal allowance issues. And we'll deal with that in the examples that you're about to see. The adjusted net income will not be involving gift aid payments or personal pension contributions. That will come later. All we've got to do is just do these calculations. Get used to the idea of computing adjusted net income. Okay, let's kick it off with example 8. Mike received gross employment income. Employment income, what type of income is that? Non-savings. Of £108,000 in 1920. We've got £32,000 of PAYE, and of course, thereafter income tax payable, so we'll need to deduct the £32,000 from the income tax liability. One source of income. The point about that, of course, is 108 is the gross employment income. It's the only income, so it's the total income. There are no deductions from total income. It is the net income. It is also the adjusted net income, as there's no reference to either gross personal pension contributions having been paid or gross gift aid payments having been made. So 108, therefore, is our figure of adjusted net income. So you'll be able to see the answer in a moment, but using the, if I clear this there, using this calculation, adjusted net income is 108. Minus 100,000 is obviously 8,000. What's half of 8? It is 4. That is the amount by which the personal allowance is reduced. So what started as £12,500 is reduced by 4,000, so the revised personal allowance will be £8,500. Let's have a little look at that in terms of our answer. And how we would, of course, be showing it in a written question. Employment income, as we know, non-savings. It is total income, it is also net income. Personal allowance, we need to work. We just computed it in our heads there at 8,500. Where does that come from? The normal personal allowance is the starting point, 12,500. There is then a reduction of half of the difference between adjusted net income and the income limit of £100,000. That reduction was 4, bringing the revised personal allowance down to 8,500. That is put in up here, as we've now seen, and that brings down the taxable income to 99,500. We then proceed to tax that taxable income. Basic rate band, 37,500, it's non-savings income, so that is taxed at 20%. Up to then 99,500, all of this is within the higher rate band, and is therefore taxed at 40%. giving us an income tax liability, assuming all of those calculations are correct anyway, of £32,300. Take away the PAYE, and after all that, we end up with a princely sum of £300 of income tax payable there. Okay, so they're a nice basic example to get us started. Let's just go back then to our notes and we see example number 9. Again, although there are more different sources of income, it's going to be a very easy answer to it. Trading income, non-savings, is 130. Bank interest, savings income, is 40,000. Dividend income, obviously, for analysis purposes, dividends, £36,000 in 1920. 130,000 in its own right, let alone there the £40,000 of bank interest, and on top of that the 36,000 of dividend income. But we can clearly see that adjusted net income, again, net income here is going to be well in excess of £125,000. Adjusted net income, yet again, no mention, as I said, there wouldn't be at this stage until we've dealt with section 5. No reference to gross gift aid payments or gross personal pension contributions. So that's it. What is total income is net income, and that is also adjusted net income. It's in excess of £125,000, so the personal allowance will be nil. Let's just, oops, wrong one again. Let's just again look at the answer to that. We've got our analysis here, our non-savings, savings, dividend. There is no personal allowance, that is. Now, I've shown here the computation. We would be taking our net income, adjusted net income of 206,000 minus 100. Well, obviously half of that would be a figure way more than 12,500. So it's restricted to nil. Alternatively, you say, and what I'd recommend you do here if answering a written question, only if answering a written question do you have to write anything, is to simply state that as adjusted net income exceeds or is at least 125,000, the personal allowance is reduced to nil. End of story. Okay, so no personal allowance to go against any of these sources of income. So what is the income is also the taxable income. £206,000. We do have bank interest, so as we know, we have savings income. And what does this mean? When we go to that level of income, taxable income of 206, we're an additional rate taxpayer. As an additional rate taxpayer, there is no savings income nil rate band. Something again there to remind you of. We've mentioned it before, you haven't seen an example where it's been illustrated before. Here it is. So there's no savings income nil rate band. And of course, at least, to be fair, £130,000 worth of income is to begin with non-savings. Clearly that is more than 5,000, so there's no 0% starting rate band available for the savings income either. So, having calculated the tax on the non-savings, 130,000, 37,500 basic rate band at 20%, we have then 92,500, the remainder of your 130,000, hopefully that will come then in total to 130,000 in the higher rate band, and is now taxed at 40%. That's 130,000. We now move to savings income, no starting rate, no savings income nil rate band. The higher rate limit, the additional rate threshold, is £150,000 of taxable income. And what have we got? 130,000 so far. So there's 20,000 of the higher rate band remaining, which is taxed at 40%. Anything over and above that, here, 40,000 savings. That leaves another £20,000 of our 40 to be taxed, and that is up in the additional rate band. We're now into additional rate, but of course with dividend income, irrespective of the level of income, every taxpayer enjoys the dividend income nil rate band of £2,000. So that's at 0. That's 2 of the 36, leaving 34,000. look again to your rates and allowances page, and there, 38.1% is the additional rate relevant for dividend income. So, back to our answer. We've now established what the individual amounts of non-savings, savings and dividends income, what tax will arise on each portion of that, add it all together, and we get what hopefully adds up correctly, again check the numbers please, as the income tax liability, and our statements here as to why it is that there is no savings income nil rate band, there is no 0% starting rate band, there always is a 2000 dividend income nil rate band there. So have a little look through, make sure you are happy with that before then we return to have a look at a further example on this restriction of the personal allowance. Okay, so here's one for you to have a go at. Just a couple of sources of income. Again, what was our approach? What do we have to compute? Income tax liability. It will of course always be for our tax year 1920 here. Got trading income, non-savings, £102,000. At this point, having just read that one figure, you know we're talking about net income that is going to be in excess of 100,000, so we may face a restriction in that personal allowance. I say we may face that because until we've dealt with Section 5, we don't yet know about how we reduce net income by the gross amount of either gift aid payments and or personal pension contributions. That awaits us in just a little while there. But we've got 102 plus bank interest, that's savings income of £4,000. Wherever the savings income, we're thinking about the very special rates that may apply. The 0% starting rate. Clearly not going to happen given the level of non-savings income we have. Then, of course, there's the savings income nil rate band. Will it happen here? Well, that's your decision to make, of course. I wouldn't want to spoil this one for you. So have a go. Set up the income tax computation, your sources of income, your analysis columns, get your total, get your analysis. And then, because the adjusted net income, 102 plus £4,000 there is 106,000. There's going to be a restriction in your personal allowance. Compute your revised personal allowance, and then as ever, take it away from your income in order. Here, non-savings. Well, obviously, it will all be absorbed by non-savings. Thereafter, had there been an excess, it would go, as you know, to savings and eventually to dividend income. But here, it will all be absorbed by the non-savings. Get your taxable income and then proceed to tax. Again, just be careful, of course, is how you tax the savings income. Over to you. Okay, let's see how we've fared therefore, and again, I'd hope no problems here. Pick up our sources of non-savings income and savings income. We then need to compute the personal allowance figure, given that we know that net income and in line with that adjusted net income here, they exceed 100,000, our income limit. That income limit, by the way, is not a figure that you'll have to memorise, though I think you probably will. It is, of course, to be found on your fact sheet there. Income limit, £100,000. All of this under the heading of the personal allowance. There's one other figure in there, something called a transferable amount. Well, that's where we go next after we have finished this particular example. So, going back to our calculations here for the revised personal allowance. We've got the normal personal allowance, 12,500, less half of what's the adjusted net income, 106, compared to the income limit. Half of 6 is 3, take it away, we get £9,500. Deducted as ever from non-savings income as well as total. 92,500 of non-savings income means, of course, that there is no 0% starting rate band available to you. But what about the savings income nil rate band? Do we have one of those? Well, unlike the previous example where we've been dealing with an additional rate taxpayer where it's not available, at a higher rate taxpayer, although it's not at the higher level, you do, of course, get the reduced level of £500. So let's do our tax calculations here, non-savings, the basic rate band limit of 37.5 at 20%. Before we then move into higher rate, now that leaves us out of 92.5. We've already dealt with 37.5. That I think leaves us with 55,000 at the higher rate of 40%. Savings income, it's only 4,000, of which the first 500, given that we're only a higher rate taxpayer, benefits from the savings income nil rate band, and the balance of 3.5. Again, savings income there, other than where the 0 or nil rates apply, going to be taxed the same as non-savings. We're in the higher rate, it is therefore 40%. Do your calculations, add up your tax, and hopefully it's your income tax liability computed there. Again, the further notes about how we've dealt with the savings income. Now we will see more interesting versions of this after we've looked at, as we've said, section 5 in the notes, which deals with the calculation of what we know as gross gift aid payments. Section 5 is very much specifically to deal with gift aid payments, but the same concept in terms of an amount paid being, as you'll see, grossed up for the basic rate of income tax. As a very simple calculation, the amount paid times 100 over 80, as it will prove to be. Don't worry, we will see that later. That applies to both gift aid payments and personal pension contributions. Pension contributions are in their own right a separate and important area. We have a chapter, chapter 10, that deals with pensions there. So there's a lot more behind that basic point. So section 5, an important one. We'll come to that, as we say, later. So hopefully okay here in terms of putting together your calculation again of the income tax liability. Now, a moment ago, we looked at a transferable amount of personal allowance. So if you go back to your notes, chapter 2, of course, here, page 10, we have the note that deals with this and explains what it is, how much it appears to be. Again, looking at your personal allowance figures there, as it's called, this is the information provided to you in the exam on your rates and allowances page there. It's £1,250. Let's see where that comes from and how it works. So going back to the note. An election. This is down, therefore, to the taxpayer to make their mind up whether a taxpayer, it's going to be one spouse or civil partner to another, wishes to transfer the figure of £1,250, now on a basic personal allowance of £12,500, that therefore means we're talking about 10% of that personal allowance. And that is a standard and fixed amount of transfer. The amount is set at £1,250 there for our particular tax year. Where does £1,250 come from? We've always been taking 10% of the figures of the personal allowance. Okay, so we can transfer this fixed amount of the personal allowance to a spouse or civil partner. It is for our tax year £1,250. When can this election be made? To qualify for this particular election, it's only available when both taxpayers are either basic rate taxpayers or non-taxpayers. If you've got a higher rate taxpayer, there is no transferable amount of personal allowance. The usual situation, of course, where it's going to be made is not where both are non-taxpayers or both are just basic rate taxpayers. It's where we've got one of each, where we have a basic rate taxpayer, but another taxpayer is not using all of their personal allowance and therefore is a non-taxpayer. Such a shame to waste that personal allowance. Now, although some of it may still be wasted, at least 10% of it will be able to be preserved as a transferable amount. Now, how that shows on a computation is a separate issue, and I'll come to that in a moment. So, where you're going to see it and where it is worthwhile, remember, if it's an election available to a taxpayer, you only make it if it's worthwhile there. Only going to happen where one spouse is a non-taxpayer and has an amount of unused personal allowance that would otherwise be wasted, and the other spouse is only a basic rate taxpayer. You can't make a transfer to a higher rate tax-paying spouse. The election, again, just a time limit thing. You've got plenty of time to make your mind up, made within 4 years of the end of the tax year to which it should apply. If it's made within the tax year, rather than up to 4 years after the end of the tax year, then the election will remain in force for future years. So if this is something that's likely to repeat itself year on year, then you can make it in the year it's operable for that year, and it remains in force for future tax years as well. Now, don't worry, you're not stuck with that ad infinitum until it's either withdrawn or the conditions are simply not met. Now then, you're probably thinking that, right, this $1,250 transferable amount of the personal allowance, I've just added on to the personal allowance of the transferee spouse. So I'll take the 12.5 plus 1250. No, we do not do that. Because that, again, well, it's taxation and we have often silly rules here, but it ensures, as we've said all along, that only basic rate relief is given. And what it is shown as is a tax credit, something called a tax credit. So the relief is not given as an increase in the personal allowance, but the transferee gets a tax credit to be deducted in deriving the tax liability of the transferee taxpayer. And it's taken at the basic rate of tax 20%. And for 1920, there's your 1250 at 20%. It is a £250 tax credit that we're talking in terms of. Now, a tax credit is a reduction from what would otherwise have been your tax liability. So, the amount can only reduce the tax liability. It cannot create a repayment. The amount of the transferable personal allowance will be given in the tax rates allowances, as we've seen, provided in the exam. And depending on what text you may be using, if you're using another text at all, or you may be reading around the subject, you may see it referenced as the marriage allowance or marriage tax allowance. Those are just other terms by which it may be referred to. Right, here we've got an example just to illustrate this. We've got David and Victoria, two names that I seem to remember go well together. David and Victoria are married and in 1920 tax year, David had a trading income assessment of £10,000, Victoria salary of £30,500. So, Victoria has got non-savings income of £30,500, clearly a basic rate taxpayer. David, trading income assessment, again non-savings, but it's only £10,000. That is less than the personal allowance, therefore. Therefore, it would be sensible if we made the transfer. From whom to whom? David is not using all of his amount of personal allowance. Therefore, rather than just waste all of that excess, the personal allowance, as we know, is £12,500 there, if I could just write it on this screen. £12,500. The trading income assessment is £10,000. We're wasting £2,500. Well, that doesn't have to happen. What we can do now is to transfer the transferable amount. There is no other figure. This is a fixed amount. It will be £1,250, whatever, across to Victoria. Victoria will not use it as an increase in her personal allowance, but instead as a tax credit. Let's have a look at how that manifests itself in terms of an answer to this, therefore. Right. David's income tax computation would read, trading profit, 10,000. Revised personal allowance, David of course started, as everybody does to begin with 12,500. We transfer £1,250. That leaves 11,250. So again, still leaving sufficient personal allowance to cover the trading income that he has. So nil taxable income arises. Victoria, she's got 30,500. Her, again, doesn't change, her own personal allowance. So she's looking at a taxable income of 18,000. So what type of income is it? Employment income, non-savings, or within the basic rate band, so non-savings, 18,000 at 20%. It means she would, without this election in force, have been paying £3,600 worth of tax. What we now have, of course, is we get this tax credit, the personal allowance tax reduction, as you may call it, or tax credit, £1,250 at the basic rate of 20%. There's your £250 deduction. Therefore, instead of paying £3,600, pays only £3,350. If it's going to apply for a tax year that has ended, then it must be made within 4 years of the end of that tax year. Again, silly therefore not to take advantage of that and therefore get the benefit of a reduction in Victoria's income tax liability of some £250. Okay, that's the transferable amount there of the personal allowance. Just going back to your note, you'll see that next up we deal with deductions from total income. These will come up next time, and for the moment I'll leave you to review back through what we've covered so far in Chapter 2. Make sure you're okay with it before we forge on to the next part of this.